Korea saying they're going to be capping some prices around energy. Japan is looking at a similar picture, and the UK Prime Minister as well nodding to this. In terms of front-ended rates, by the way, worth noting, we have a terminal chart that shows this. Front-end rates in many jurisdictions, many countries now, yields are above the benchmark line for central banks. You're seeing that in the UK, and you're starting to see that in other major economies as well. The front-end yields higher than the rates set by these central banks, and that calls into question how far they can go with the BOE now not expected to cut by traders this year.
Yeah, ex-BOE, Michael Saunders arguing that if this surge continues, the MPC is going to be set for an extended pause because of the memory of the second round effects that happened in 2022. They do not want that to happen again at the Bank of England, he would argue. But in terms of that fiscal stimulus that you talk about, Tom, Keir Starmer raising the prospect of intervening to help households with their energy bills, but the IMF's Kristalina Georgieva saying you need to be very careful about deploying stimulus given the existing debt loads from all of the crises that have been in the pipe from previous times already in many different countries. So when you come to that broader market reaction, you've talked about the bond story, the stock story, also dramatic today. You've seen South Korean stocks especially battered on the Kospi, Asian stocks getting the brunt of this because they're so exposed to energy in the Middle East. But in South Korea, of course, investors taking profit from that AI boom. And then in Japan, the Nikkei 225 entering correction territory.
So eyes on stocks, eyes on bonds, as you were saying. I noticed that traders are now boosting their ECB rate bets, fully pricing to ECB hikes in 2026. 7:30, probably before then, we'll start to get the open of the European bond market. So we'll watch for that. Over in Asia, New Zealand 10-year bond up 19 basis points, Aussies up 14 basis points. And then we come to Europe, where the indebted nations have been a concern, and we'll certainly watch gilts and we'll watch the European bond market space. Gold, you mentioned that, not acting as a haven, because yes, it can be somewhere that people go as an inflation hedge, but when inflation concerns build so much that you're then worrying about interest rate hikes, as we really are this morning, then that tends to weigh on gold, which of course doesn't have a yield. You add in the dollar effect and the fact that gold is a source of liquidity, and that means that the gold price is weaker. But I know not by as much as it was, down 1.5%.
Now, what matters for markets is the length of the war, and you've got prediction markets now putting a 48% chance on the idea that there still won't be a ceasefire by the end of next month, and really neither side backing down here. So as you say, we've had Iran naming the late Ayatollah's son as the new supreme leader. This is Mujtaba Khamenei, and the Islamic Revolutionary Guard Corps pledging their allegiance, their full obedience to him. It's basically more of the same. You said keeping it in the family, Tom. At least it's not a choice that suggests that surrender is coming.
The reading is that this move by Iran is a hardline move, that this is a hardliner. You have, of course, President Trump coming out over the weekend saying he wants unconditional surrender. So you get the narrative both sides, and you're seeing that in terms of how they continue, of course, their military response. Both sides digging in. That brings us to the time frame question. And it's interesting when we tie that in terms of how we think about the time frame. That is so crucial for the markets. And when we think about the reserve story and whether or not additional reserves can be put onto the market to ease those prices, does that actually give President Trump scope to go further and to drag this out longer in terms of how we think about the pressure points on this president? What for him is the point at which he sees the losses in the equity markets, higher oil prices, higher petrol prices at the pump? To what extent is that a constraining factor on President Trump going forward?
Yes, I mean, he is going to be getting this morning higher Treasury yields. He's going to be getting weaker stocks. That he's going to be addressing Republicans later on today, we understand, in the House. So he's definitely going to be getting their forthright views, perhaps, on what's happening here. But in terms of the oil market signals, I mean, he's standing quite firm, isn't he, suggesting that this is short term and that longer term this will be, the oil prices will come down again. But it is a very, very relevant question, what kind of feedback the markets give to the presidency about what is being enacted here. At 7:08 here in London, let's tell you about all of the conversations we're going to have this morning during our program. We'll talk to Angelina Valavina, Fitch Ratings head of EMEA Natural Resources and Commodities for EMEA Corporate. How much of this is about trying to create different oil prices in different parts of the world? That's something that we're going to be putting to her and talking about. Helen Jewell will be with us for the Market Open, BlackRock International CIO fundamental equities? Where, if anywhere, do you aim to hide or at least ride out the volatility and the negativity for risk assets right now? We'll also talk to Oleg Wodnitsky, who is the UForce CEO. Now, of course, this is a business that's bringing together a lot of Ukrainian startups on the defense space. So defense will certainly be part of our conversation this morning.
Let's look ahead to what else we're watching throughout the week. Today, we have, as we mentioned, G7 finance ministers discussing a joint release of emergency oil reserves. This reported earlier by the Financial Times, and moving the oil price a touch lower. Then tomorrow we have EU finance ministers meeting in Brussels. On Wednesday, it's US CPI expected to show some easing inflation, but of course this was before the outbreak of the Middle East war. Then on Thursday, it's US jobless claims, and on Friday we have UK GDP and industrial services and manufacturing production, plus US GDP and the Fed's preferred inflation gauge, PCE, plus JOLTS and the UMich survey as well. So core PCE expected to show an increase in January, but I would just point out as well, US clocks have gone forward, so the time difference with Europe is a bit narrower. Yeah, and so we follow suit in 3 weeks.
Important note. Let's just reflect on what Anna broke for us a couple of minutes ago. It's gone red on the terminal right now. Traders boosting ECB rate bets, fully pricing in 2 ECB hikes in 2026. Just take a beat, because 10 days ago, the view was the ECB would be on hold for a prolonged period of time with rates at 2% from the central bank. The Bank of England had it priced, two additional cuts this year. That has been wiped out. This is remarkable in terms of how quickly traders have readjusted their views on these central banks, on this energy shock and inflation risks.
It really is. And I spoke to Joachim Nagel of the Bundesbank last week, really hesitant to talk about how this is going to impact the ECB's path ahead. Oliver Crook spoke to Ollie Wren as well. And I think the market pricing now is really testing ECB officials cool on how much they want to talk about what the reaction function is going to be to this. But of course, the memory is there of 2022 and Russia's invasion of Ukraine.
You've been through the week ahead. We've got US CPI, which is going to be one of the data points we'll be watching for. We got non-farm payrolls on Friday, which was quite fascinating, because on another day we would be talking probably still about that, because it was quite a turning point with such negative news flow. But I was amused this morning to read a note from Rabobank that said anyone thinking US payrolls at minus 92,000 matters much in the current environment is probably going to be replaced by AI anytime soon. So that being said,
unemployment went up to 4.4% from 4.3%. You're expecting growth in jobs of about 55,000. You got minus 92,000. But to the point in terms of how challenging this makes the Fed's job, with a weakening labour market and higher inflation, this is a stagflationary environment that we're looking like for the US and other economies. You've got a weakening labour market and likely higher inflation than the US.
And it was across a number of sectors. There you go. I've fallen into the trap of making it look important on a day where lots of other things appear to be important.
But add in the idea that the Fed chair is going to be a dove.
Yeah.
It's a conundrum for Kevin Walsh, the incoming Fed chair. Likely has to get through that confirmation process. Here's what else you need to know this Monday morning. New York City police are investigating a potential terrorism link after an improvised explosive was thrown near the residence of Mayor Zohran Mamdani. 2 suspects are in custody following the incident on Saturday, which triggered a bomb squad response. Oracle and OpenAI have scrapped plans to expand an AI data center in Texas after negotiations dragged on over financing and OpenAI's changing needs. The collapse talks creates an opening for Meta to step in and consider leasing the planned expansion site. The change underscores the complexity of building out AI data centers, which are expected to cost in the tens of billions of dollars and require cooperation from a wide swathe of partners.
Since the dawn of time, man has been plagued by itch and irritation from not wiping clean. What man didn't realize is that wetter cleans better. See how Wet Dude Wipes completely clears while Dry TP smears? Ditch the itch and switch to Wet Extra Large Dude Wipes. The best clean, hands down.
But here, back to tell you about Realtor.com. With over 500,000 new listings a month, you can find your dream home today. Well, isn't that cozy? So work with number one and make it real with Realtor.com.
Dog grooming genius here, and I live for operational excellence. Cute makeovers? I see a shop in sync. Checkouts? Flawless. From game day crowds worldwide?
Gabrielle turned her passion into a thriving business with Hostinger. Now it's your turn to take your idea online. Create and launch your website in minutes with
Chancellor has suffered a setback in crucial state elections, losing the state of Baden-Württemberg to the Greens. Philip Merz's CDU party had been projected to win back the state for the first time in 15 years. A reminder of the domestic political challenges we're seeing in France, in Germany. This is a weak coalition that you're seeing in Germany right now, and a pretty significant blow, given the polls have suggested that the CDU would take this traditionally conservative state.
On the one hand, I mean, there was some sort of personal gas that the person that the CDU had put up, made, and that's been credited or given as a reason for why this happened. And also, this is a place that the Greens have had for a number of years, 15 years. So in that sense,
a bad entry here. We should have waited till price gets away from this POC. A lot of activity here. It's gonna flip-flop until.
Did have a look at SAP in the battery. That's a
should have reversed that.
Crosshairs of the AI disruption story right now. But in terms of what this tells us about Philip Merz and his ability to sell that message, Chancellor who has unleashed the spigots in terms of spending, and at a time of increased spending on infrastructure and defense, clearly there is a groundswell of and support for the AFD as well as the Green Party. The AFD performed very well in this election, normally almost doubling their numbers in terms of the votes. So this is a chancellor who has opened up that spending spree and yet is not being rewarded at the ballot box, it seems.
Yeah, absolutely. Jobs certainly in some of the sectors you mentioned, a focus of this vote. Coming up in the programme, we'll take a look at what we'll continue to keep.
The dollar is showing weakness.
This morning, and we'll add into that what we're seeing in food and agriculture prices, the sector being rocked. We've seen a jump in wheat prices to near a 2-year peak as war in the Middle East drives energy and fertilizer costs higher. Plus, we'll bring you all of the details on the market sell-off throughout both hours, and keep an eye on the European bond open at 7:30 a.m. London time.
Didn't get back above POC.
Joint emergency oil
reserves rally up.
According to other media this morning. More on that with Angelina.
Struggling right now.
From Fitch Ratings. If you have any questions, please get in touch with us. IB plus BBTV Go is the function to use. On the Bloomberg terminal, it is really foggy, misty in London this morning. I feel that's an appropriate metaphor for a lack of visibility around these markets right now. This is Bloomberg.
Welcome back. We're a little over 40 minutes away from the Monday trading session. Let's check in on European futures then. And if there had been complacency in these markets last week, there is far less of it today. As you can see, European futures across the benchmark pointing lower by 2.6%. You're looking at losses over in Germany, potentially 2.5%. The FTSE 100, a little bit more resilient. Some of their European counterparts will look to energy to play the part there. The CAC current over in France pointing lower by a full 208 points. Let's flip the board and have a look at the US futures picture. You had seen relative resilience in terms of US equities last week, closing lower by about 2%. That compares to a drop of about 4% for European stocks and about 6% for Asian stocks. Today, US futures pointing significantly lower. S&P E-mini scored lower by 1.6%. NASDAQ futures pointing lower by 1.7%. And Russell 2000, the small and mid-sized cap companies looking to feel the brunt of the squeeze, pointing lower by a full 3% as things stand.
Now, of course, it all comes back to oil. We've seen crude oil surging above $100 a barrel for the first time since 2022 as more Middle East producers curb production with the Strait of Hormuz all but closed. The Middle East conflict showing no signs of abating after US and Israeli strikes on Iran, with the fallout stoking fears of rising inflation. Speaking in an interview with CNN, the US Energy Secretary Chris Wright downplayed the jump in prices.
We have that oil. We have the world is very well supplied with oil right now. The United States is a net oil exporter. We're a net natural gas exporter. We are suffering high prices, not in natural gas, but in oil, because it's a globally connected market. We're communicating with our allies abroad. The oil is there. You're seeing a little bit of fear premium in the marketplace, but the world is not short of oil today or natural gas.
So that's one view. Let's get another now with Angelina Valavina, head of EMEA Natural Resources and Commodities for EMEA Corporates at Fitch Ratings. Thank you for making time for us this morning, Angelina. You just heard there from the US Energy Secretary, essentially saying that this oil price spike is a short-term blip. Is he right?
Thank you very much for having me on the program this morning. And yes, we do agree with that. So the Iran conflict obviously has triggered a significant turmoil in energy markets, both in oil and gas. The Brent oil price, as you said, reached 100 upward for Brent dollars per barrel from 60 at the beginning of this year. But currently, the key risk to the oil markets, upside risk to the oil market, stems from the effective closure of the Strait of Hormuz. And we do believe that the closure is likely to be temporary, irrespective of how long the conflict may last. Obviously, there are a lot of uncertainties about the conflict, the duration of the strait closure, potential damage to the infrastructure, to the physical oil and gas production. But our current baseline assumption is that the closure of the strait is likely to be temporary. And obviously, the oil prices will be very volatile. There will be a spike. The geopolitical risk premium is very high, but we do expect the prices to moderate once the transit through the strait restarts. And the market will go back to its fundamentals, and the oil market is oversupplied.
Okay, interesting. We also learned earlier today that G7 finance ministers will be discussing a possible joint release of oil reserves. We saw oil price gains pairing a touch off the back of that news. How significant is it, and will that move in oil prices last?
It is significant in the sense that it can pull down the oil prices. But as I mentioned, it's the Strait of Hormuz. This is the key risk and the key point to stabilize the markets. If we talk about the reserves, then the global observed oil inventories stood about 8.2 billion barrels at the end of 2025. And it's pretty much at the level we last saw in 2020 after the COVID. And this amount is sufficient to cover the shutdown of the oil shipments by the Strait of Hormuz for over 400 days.
Angelina, it's interesting. You talk about how the closure of the straits will be temporary, as if it sounded as if you think you can disconnect it from the length of the war. But why would Iran be incentivized to open up the straits if the war is not over?
So what we currently observe is the oil transit volumes through the strait dropped to a minimum due to the high risk of Iranian attacks on tankers and then challenges to obtaining the war risk insurance on the vessels. And as the storage is being filled by the oil producers, we have seen the news that the Gulf states have started to curtail their production. And just a reminder, about a fifth of the global oil consumption is transited through the strait, so it's quite important. The reason why we believe that
okay, so we're back above value value area high here. We can stay above here and get aggressive buyers, show conviction. We can take, we need to displace, take this liquidity, this swing high here, and then target the liquidity up here. I mean,
it's also an important artery
stuck buyers,
transportation, but also for food transportation. And two other important points is the potential Navy protection for the tanker vessels, for the navigation of the tanker vessels of the strait, which was already observed during the Iran-Iraq war in the 1980s.
The dollar is weak.
And the last point is insurance. So at the end of last week, there was news that
NASDAQ is showing strength.
Announced the plan to deploy maritime reinsurance, including the worries in the Gulf region for about 20 billion. So the combination of these factors is likely to support the reopening of the strait.
Angela, I just want to get your take then, if you fold that all together and get your view then on the outlook for prices. We started the session this morning
the VIX is below 30.
Then we had the news about the reserves potentially coming into bear, and we're a little lower on the back of that in terms of where we were at the start of the session. What is your out? Where do prices end this week? Given that we can assume possibly that the Strait of Hormuz will not be open in that time frame. What are we getting back to 120 by the end of this week? Do you think?
When we look at the oil prices, we look at them on average for the whole year. So if our assumption is correct and the Strait of Hormuz is effectively closed for a temporary period of time, then we will continue seeing the very high geopolitical risk premium with the prices of 100 or above during the period of closure. And once it reopens, the prices will go down towards the balance in the market, supply and demand balance. So then on average for the year, we might see the price around 80 or even 70. But that's, again, the risks to that are very high and there is a lot of uncertainty.
Angelina, the US is
So we guaranteed ourselves break even.
Right now.
We
Can the
cannot
US
lose this
shield itself
position.
from what is happening in
Hopefully, we
global
can
oil
hit our
markets?
target. The high of the day,
Markets are global.
the daily
So the
high.
impact is across all the different regions.
All this
because of the
liquidity
oil
here.
prices. There may be a small variance between WTI and Brent. It's usually between
What did the market do
$5.
this morning at open?
Generally speaking, the oil
Looks
is
like
a
it
global market. And
manipulated to the
the
upside,
oil
left
prices
trap
will be-
buyers up here, came down.
Okay, Angelina,
And
thank you very much. Indeed, we're seeing WTI above $100.
these sellers
today,
down
101,
here
gains of 12%
got
so far in the
stuck
session.
here,
Angelina,
went back,
gonna be
it
ahead
swung
of
back,
the
rotated
national
back to
results.
grab the
Full
liquidity.
Bureau corporates at Fitch
And
ratings
then
with an analysis. Coming up,
swung
Iran futures a
around,
hardliner to become the next.
consolidated for a bit
We
before
discussed the potential
now
US
looks like
response
it's
to that decision.
trying
That's
to
coming
get
up. This
this
is your
liquidity up here. Hopefully we can get there. We're above value. We did not get the best entry. We got a terrible entry actually. Should have waited for the swing into POC. Nevertheless, that's a great wick on these sellers here. See buyers trying to reject these sellers. Let's see if we can close.
This is the opening trade at 30 minutes from the start of
At least
the cash equities.
we got at least displaced this
And we
swing.
are tracking the impact of higher bond prices across all kinds of assets this morning. We are up by 14% on the Brent price. And so this is the picture of what that's going to do to stocks. Euro Stoxx 50 futures down 2.2%. FTSE 100 futures could show some resilience because of oil majors there. We saw Saudi Aramco, for example, going higher in the session yesterday.
Dollars
in the
below value area still showing
down by
weakness.
2.3%. So focus on what the higher yield environment, the higher energy price environment will do to consumers and industrials and the rest of the European economy. That's all.
Continuing to rewrite those rate expectations, and you see that pricing in for the ECB, 40 basis points of hikes now being priced in by the markets when it comes to the ECB. What a turnaround. So that is fueling the sell-off once again for the debt space, sovereign bonds in France, in Italy, in Greece, and you can expect that dynamic to play out for UK gilts as well at the open at 8 a.m. UK time. You can see those moves, 8 basis points higher in yields for French OATs. You're seeing a more pronounced sell-off at the front end, 359 on the 10-year over in France. BTPs, a 12 basis point move higher in yields, 374 on the Italian benchmark. And over in Germany, the 10-year yielding 2.9, closing in on 3% with yields up 5 basis points. This is a dynamic we continue to watch, and it's evolving at pace, Lizzie.
Well, as you say, Tom, global bond markets tumbling as the oil price shock prompts investors to price in higher inflation and a deteriorating economic growth outlook. Let's get more now with Bloomberg executive editor Paul Dobson. Paul, this has been the worst open of the Iran conflict so far for German two-year bonds. Do you expect the gilt open will be even worse?
It was certainly do well to avoid a similar sort of a fate, given the way that the market is pricing in extended inflation risks and the need for central banks to take that into consideration as they set policy for the rest of the year. And there's plenty of potential for the BOE to have to change an opinion where it had been leaning towards the idea that there would be more cuts. So if the market starts to back away from that or price in the other direction, would push those yields higher. I think it's important to remember on the one side, bonds are still positive year to date. The returns might not be very big, but they are still eating out gains. So this isn't a calamity as far as bondholders are concerned. But on the flip side of that, they're supposed to be a haven asset. They're supposed to perform well when we have negative shocks to the economy like this one looks like it's going to be. But because of that inflationary dynamic, they're failing to provide that functional purpose. And so with a 60-40 portfolio, for example, where you might expect some gains for bonds to offset some of the losses in equities, you're not really getting that at all.
Yeah, not acting as the haven, certainly preoccupied by the inflation dynamics then, Paul. And as a result, we see swaps implying 2 full 25 basis point hikes by year end. This is for the ECB, of course. That's compared to just expecting 1 on Friday. So things are moving really quickly. I mean, how quickly would we expect central bankers to start recasting their expectations for the year around this? Because oil prices, I mean, economists and others will tell us that if oil prices have gone up this quickly, things are very unpredictable. They can fall quickly as well. And so perhaps it is the longer they stay at these elevated levels that has the impact.
100%, I would agree with you on that. Anna. And if you look at the oil price curve, then it backs off again very quickly. So the levels for contracts due at the end of the year are still only just a little bit above $70 a barrel, as opposed to the very high prompt prices that we're seeing, because everybody knows that, you know, once things settle down again, the price could come off fairly rapidly. But there's two things that people are taking into consideration here. One is each day that we have the shut-in, so people can't get the oil out of the Strait of Hormuz, it reduces the amount that's around in the global market. But as people start to close down some of the infrastructure because they just don't have anywhere to put the oil anymore, it takes time to get that restarted again, with the added danger that there will be strikes, you know, explosions that damage the infrastructure in the meantime. So all of those factors taken into consideration, and whether, you know, we have like a very short-term supply crunch that disappears again, even before the policymakers have their next meeting, or whether we have something that continues to drag and lift up that longer-term oil price expectations, and therefore the longer-term inflation expectations will be something that we need to pay attention to. What we did see is the break-even rates in the energy market are rising now, and that is something that the central bankers will need to start paying attention to see whether those the outlook for the higher energy prices become something that people factor into their expectations for the economy going forwards.
Every day I find people to talk to. I didn't have that at home. That's the value of holiday.
Hey, Rooster!
The kids call you Rooster? They think I'm like my character.
Nice washboard. This is college. You can be the rooster if you want.
Cock a doodle dip.
Right now, a serious job is right for you. Right now, if you're looking for warehouse, manufacturing, or engineering work, a serious job is right for you. Right now, you might be wondering, what is a serious job? At Sirius, we believe good work should come with clear expectations, fair pay, and respect for the people doing it. And that's how we hire across the country and right here in the Triad. Apply now at SiriusStaffing.com. SIRIUS staffing.com.
Much, Fieldoften, with a look at what we're seeing on bond markets, and worth just reiterating, things are getting into their stride now, and we have a full complement of European bond markets open this morning, team, and we've got the Italian 10-year up by 12 basis points. If I click into what's going on across the curve there, the 2-year is up by 18 basis points. It was up by 20 at the gate. So these are really quite substantial moves, certainly at the short end, which of course will reflect expectations around ECB pricing. We'll wait for gilt markets to open in 25 minutes time. Let's return to the Middle East then. Iran has named Mujtaba Khamenei as its new supreme leader after what has been described as a decisive vote in the Assembly of Experts. In a statement, the Islamic Revolutionary Guard Corps, the IRGC, has pledged full obedience to the new leader. Let's bring in Jumana Basetji, our Bloomberg Horizons Middle East and Africa anchor, who can give us some more context around this. Tell us a bit about, well, we know that President Trump didn't approve of this appointment. He said that before we got the announcement of his name, Jumana. But tell us more about Mujtaba Khamenei and what we should expect.
That's right. Well, he was the front runner going into the weekend. No surprise that he's now formally been appointed to become the Islamic Republic's third supreme leader, and also an example of hereditary succession, which is what some theocratic purists wanted to avoid, because, of course, his father was the prior supreme leader, Ali Khamenei, who was taken out on day one of those joint U.S.-Israeli strikes. Now, what do we know about Mujtaba Khamenei? Well, in many respects, he's as hardliner, if not more hardliner than his father.
Yeah, we got taken out.
He operated behind the scenes with Iran's power structure. He has very strong connections.
Got to move now. If it doesn't,
to the security establishment, he was placed under U.S.
If the sellers protect this level and it gets back down, and it's gonna rotate back down and just forget this liquidity. But
every time there have been
if it can take this first, this swing first,
had
then
a
we
more
can
dominant
certainly
role in
target
terms of
the next
decision making, and the
buy
likes
side
of
liquidity
the
here.
National
But
Supreme Council leader Ali
looks like we got it here. We got this already.
Mohammed Ghalibaf may also take on more prominent roles, and these are individuals that we heard from over the course of the weekend when they sort of contradicted the remarks that President Pezeshkian made on Saturday, looking to de-escalate the situation with other Gulf countries. So the messaging from Iran with the appointment of the son of Ali Khamenei as supreme leader is one of defiance. President Trump has said that choice is unacceptable and reiterated they want nothing short of complete surrender.
So how is that dynamic then, Jemana, playing out in terms of what is happening militarily on the ground in your region?
Things have intensified over the weekend. There's no other way to look at it. On one hand, the joint U.S.-Israeli operations continue. The IDF saying that they have targeted over 400 different locations in Iran over the course of the last 24 hours, including a fuel depot facility in Tehran as well. Iran, on their part, continue to fire back. Since the beginning of this war, and it is now day 10, they sent over thousands of projectiles. So we're talking more than 2,000 of missiles and drones directed at Israel and the Gulf states as a whole. And it's been another very intense weekend for the Gulf states. UAE, more missiles being intercepted, some debris causing damages at residential buildings, a fire at the Fujairah oil facilities. Saudi Arabia have intercepted several attempts at their
This level here, after it pivots above the value area high, this is a great spot to add in your order. You want to add here. Comes up,
even though some water supplies
swings
are running as
back.
usual. Again, it just shows another front potentially has opened up in this war. And then Qatar, more missiles being intercepted overnight in Doha as well. So the attacks are still
Very clean price action. What we ideally want to see to go back up is more of this small bear candles with wicks, and then
for the most part,
this,
over here in the UAE,
displacement bull candle, strong bull push. Then we can easily reach this level.
Is what we're seeing in the global markets this morning with where energy is
We
trading.
need.
Okay, thank you for that update. Jemana Besechi, of course, rises Middle East and Africa.
I do not really want to see it come back to value.
UAE, of course. Staying with Iran, President Donald Trump is weighing the option of deploying
Remember
special
here,
forces on the ground to
these are
seize
trapped
Iran's
buyers here, and
uranium.
this is a very strong rejection.
May have been moved. Let's bring in Becca
Bear
Barker,
at this
defense
level.
Bloomberg Economics.
Bears protect this level. We're going to rotate all the way back down to value.
If we got to a scenario where the US
just range back down the rest of the day.
How likely and feasible would that
We
be?
need to see some bulls
Well, it
here.
would be a highly risky scenario for ground forces, for special operations troops. Donald Trump tends to think of special operations as America's military fix-it-quick button, and that's not necessarily the case. They're not infallible.
I'm trying to come back in.
Risks to them in the Venezuela operation, and this would be perhaps
I like that wick. That's a good, nice wick there. We need a closed wick here.
to secure some of that highly enriched
Now we need a bull. We need to see some buyers coming back in.
hasn't been verified.
We need aggressive buyers.
If not longer. So it would be a very risky operation. And I think President Trump recognizes this to a certain degree. He said before that there would be no ground forces, even though he retains the right to send in ground forces, but there would be no ground forces until
The dollar's trying to show back strength here.
and that is not necessarily
It came back into value. Let's see
there's
if
still sizable threats on the ground as well as in other domains.
So heightened risks, Becca, if special forces are sent in, but what are the risks even if the conflict continues?
There are so many risks. We're already seeing some of the economic costs be brought to bear. We could see those risks increase even further, particularly if there is true kinetic action in the Strait of Hormuz. We've also already seen the economic costs that even some of these lower cost drones can provide based on some of the damage that they have caused to critical infrastructure as well as to population centers. There's also sizable military risks, particularly for the United States. There's this risk of a longer entanglement, a forever war, the type of thing that Donald Trump actually campaigned against. But the US might find itself mired in the Middle East yet again. Additionally, there's also the risks of degraded readiness, force readiness, which might leave the US military underprepared for future potential conflicts. And then there's also political risks, the risk of continued instability in Iran and elsewhere, as well as probably the biggest risk, which is the risk to the human population in the Middle East. We've already seen the human toll of this conflict in Iran and in the Gulf. And as things intensify, unfortunately, I do think that we expect to see the human cost of conflict only rise.
And everyone's looking for, with that in mind and everything else you've just described, Becca, everyone is looking for any signs of de-escalation. What are the things you're looking for? Because over the weekend, President Trump talking about the jump in oil prices as a blip and the nomination of the person that they picked in Iran to succeed the supreme leader, neither of those two things scream de-escalation. So what are the things that you're watching for?
Well, in terms of de-escalation, I don't think there's a ton of signals at this point in time. But the number one thing as a military analyst that I am watching for is a change in rhetoric from the United States and a change in rhetoric from Israel. At this juncture in time, we're not necessarily hearing this mission accomplished approach, if you will. We are hearing that, the joint US-Israeli strike campaign is going according to plan and that they're having tremendous success, but none of that actually screams mission achieved. Objectives have actually been met, in part because those objectives aren't clear, and the US military strategy isn't entirely clear here either. So, to quote General Petraeus from another long Middle East war, tell me how this ends. And no one quite knows. So until we have that, I think it's really hard to look for specific signals of de-escalation.
Becca, I appreciate your insights this morning. That's Becca Vassar, Bloomberg Economics Defence Lead. Thank you. Well, the Finnish President Alexander Stubb has been looking at the impact on the Ukraine war from the Iran conflict.
I think the end of that war is going to be very transactional as well. And I say this because the main peace mediator is the United States. So the effects on Ukraine, which I look at, there's at least one positive effect, and that is that Iran and Russia are not able to cooperate right now in terms of missiles or defense industry, albeit, of course, Russia now has already 2 Shahid factories with Iranian technology.
We'll get you more on the winding fallout from the Iran conflict next. This is Bloomberg.
Welcome back. This is the opening trade. We are 12 minutes away from the start of a European cash trading session, and it will be an ugly one if you are long at these markets. The FTSE 100 could be a little more immune to what's going on, but really not by a huge amount. So we are expecting to be down by more than 2% on many of these major markets. Here in Europe, we'll certainly be keeping an eye on any rate-sensitive stocks because we've got short-end rates in the Eurozone, probably on gilts as well. We'll wait for those to open at 8, heading higher, substantially so in some cases, as we rethink where rates go from here. Oil stocks, of course, will be in focus. And let's have a look at US futures because they're also suggesting we'll get a bit of negativity, Lizzie, at the start of the trading day.
Yes, indeed. Negativity for Wall Street. Let's get some analysis now from Markets Live Executive Editor Mark Cudmore. Mark, Anna mentioned the oil price. They're not as high as they began the day, oil prices. They have been flirting with $120 a barrel. Brent's now at 107 the barrel. On this report that G7 ministers will be discussing a possible joint release of oil reserves, but you say that the relief will be short-lived. Why?
Yeah, I mean, look, only as recently as Friday afternoon, so the last kind of trading session, Friday afternoon in Europe, people were saying, if we get to $100 a barrel, that will be really, really bad for stocks. At the time, we were trading below 90. Well, now we're hoping that oil can fall below $100 a barrel. And bear in mind, we're only one trading session later. It's quite bad out there. I actually think that stocks are trading amazingly well so far. And you got to remember that away from the fact
There's a good sign here.
Inflation shock coming through from energy prices, coming
We're
through from fertilizer,
staying above value. We have to stay above value. If we come back down here, it's going to rotate and start selling off. But
which is going to exacerbate
we can stay above value here. We can hit our target. That's a nice strong bull candle here.
I reiterate that until
so we got a chance now. We just need to see some more aggressive buyers coming in to take over this. We need to see strength from the buyers here.
We had okay growth into this factor, but this is a major risk event happening right now. And until the Strait of Hormuz is sustainably looking like it's going to be open, sustainably, I should say, this is going to keep on getting worse and worse. So I think this week's going to be really, really bad for stocks because I don't see where we're going to get that visibility of an open Strait of Hormuz anytime soon. So I think it's going to get much worse this week.
Get juicy with 5 grams of sugar and ingredients you could love. Coffee, soda's better.
Are you looking at 4x4s on cars.com again?
I honestly don't know what you're talking about.
I was thinking of something more sophisticated. Look, fine. Keep the beard.
Cars.com. Where to next?
Everything for me is about that. How I make sure that she's taken care of. All of that changed for me. And I feel just as secure in this new way. So I don't have to think about it anymore. I feel very happy. It's a great place. I feel really held.
Dog grooming genius here. No, over here. And I live for operational excellence.
Now, calling out the complacency that you saw in the equity markets last week. To be clear, do you see a less complacent equity market now? And do you continue to see the same dynamics that playing out this week, in that Asia is hit worse, then it's Europe, and then it's the US, which has relative resilience? How do you see that dynamic shifting through this week?
Yeah, it's a good question, Tom. I actually think complacency is still very high. I'm still seeing the same complete divergence in narrative between geopolitical experts who go, we have no visibility to where the end of this war will be. We don't see why it'll end soon. We don't see what the end game is planned for the US side. We don't see US, Israel, Iran showing any signs they want to stop the war. That's what I'm hearing from the geopolitical experts. Meanwhile, almost every market is going, Trump will surely attack us soon. Trump will surely want to end the war, so he'll declare war. Now, I'm not a geopolitical expert either, but I have to say, if I'm going to listen to some random macro tourists or some geopolitical experts on the geopolitical outcome, I'm going to go for the geopolitical experts. And therefore, I think people in markets are completely complacent still. And yes, of course, we can rally very violently when we find out the Strait of Hormuz will be open sustainably. I just don't see why that's anytime soon. And therefore, yes, I think stock markets in particular is where the most complacency is and much downside is ahead.
Bloomberg Markets Live Executive Editor, Mark Cardinal. Mark, thank you. Remember, you can get up-to-date analysis and insight from Mark and the rest of the team, of course. Just go to MLiveGo on your terminal. Let's bring in right now Jennifer Carreri for a check on some of the stocks on the move, or could be on move at the open. Which ones are you looking at, Jennifer?
Good morning. Well, we talked a lot about oil prices, and I want to draw your attention to the metals and mining sector. That's after JP Morgan and Morgan analysts downgraded a host of EMEA metals and mining stocks, reversing their previously positive view on the sector. So we've got Anglo American, Rio Tinto, Antofagasta, ArcelorMittal. ArcelorMittal double downgraded to underweight, Anglo cut to underweight, Rio, Antofagasta cut to neutral by those analysts. Those analysts saying that the market reaction has been so far relatively benign and that they're surprised by the reaction so far and that there's more near-term downside risk associated with global impact to growth from oil prices. So we could see those stocks move on the open. Next up, we're going to flip over to Roche, the Swiss pharmaceutical company, saying that a stage 3 breast cancer study did not meet its primary objective. Now, that study involved a combination of its investigational drug, giredestrant, with Pfizer's Ibrance. Roche saying that the study did not lead to a statistically significant improvement in advanced cancer breast cancer patients. Next up, we're going to end on a bit of M&A news, and that's Telefonica. Financial Times reporting that Telefonica will consider further takeovers of UK broadband providers, quote, if the deal is right. Now, that comes after the company struck a $2 billion deal for UK broadband rival Netomnia last month. And Telefonica, bearing in mind, already owns a 50% stake in Virgin Media O2, and it's focusing on a couple key markets, including the UK, as well as Spain, Germany, and Brazil. That stock could move on the open.
Okay, well,
thank you very much.
taking out break even, could not get back up to
but that wider mix is negative, isn't it? We've got
buy-side
European
liquidity,
pointing decidedly lower, US
daily
also
high.
pointing substantially lower, down by more than 1.5%.
Looks like it's just going to rotate back.
And this is the picture for European stocks. Then we'll watch anything that's rate sensitive, anything that's oil sensitive, consumer stocks certainly will be in focus. Travel and leisure in the mix
We
too.
can check the Nasdaq. Nasdaq is way up. That's it. Try again tomorrow.
Welcome back to the program, everybody.